Good morning. Let us start the weekly review very quickly because we have a lot to get through. So as we start always with the two-year note, we shall do so again. Well, on a weekly basis, the two-year note had a very slight negative performance this week, which is not surprising given the very strong non-farm payroll number. But hardly 2 basis points. Nothing to write home about. It's still uptrending nicely, being caught by the Bollinger Bands on the weeklies. What is far more positive is the 5-year note, which has managed to contribute a small upward performance and still being caught by the Bollinger Bands. And the real flattening of the yield curve is coming in the tens, not so much in the tens. As you can see, another positive week. 1, 2, 3, 4, 5, 6, 7 positive weeks on the trot now, which is, I would have thought, a record. So it would not be surprising to see another at least 2 or 3 or 4 weeks of backing and filling here. And finally the 30-year note, which is just the stellar performer. Let's look at the weeklies because the dailies are not as good. 1, 2, 3, 4, 5, 6, well, 7 really weeks of fantastic performance in the 30 years. It is through all the Bollinger Bands, all the resistance lines. Basically, it's doing a moonshot. So again, even here, it would not be surprising to see some give up. But we feel that the flow of money is just so strong that any dip here, even back to this trend line, is going to get bought very aggressively. In Europe, we have much the same story. Schatz, positive performance. I mean, this stuff is trading at minus God knows what. And still it manages it to go more negative. Same thing for the Bobble on the weeklies, even more negative. 1, 2, 3, 4, 5, 6, 7 weeks of performance, all on the upside, all more and more negative yields. And finally the Bund, which itself is doing exactly the same thing. It is through the Bollinger Bands on the weeklies, and it just keeps on trucking. There is no stopping it. We have decided we will take off our short Bund long 10-year note position because it's just not performing, and we feel there could easily be a huge squeeze here. And we could go to negative 40, negative 50 without too much of a problem. So, having said that, let's have a look at how that has impacted other asset classes. And really the best way to view that is through the weekly performance of the cash US. Well, we closed last week around 21.05, and this week we are at 21.30. So 1% and a bit. Let's talk about what is going on here longer term. That's why we are looking at these weekly charts. Well, if we look at this move here from the low in 2009 around 666 as being wave 1, then we have a completion of wave 3 in 5 waves here, then an ABC retracement with a wave 4, that would basically mean that we started wave 5 to the upside. More often than not, wave 5 and wave 1 match in some degree. You might agree with us that this area here, i.e. the price action in the last quarter of 2008 until the middle of 2009, looks quite similar to this price action here. In which case we are in time, we are here at the beginning of this area that we have highlighted with this ellipse, and we feel that we might be getting in the next few weeks the same price action, i.e. next week a very tentative rally and then a give up, and then more rallies and give ups for something like at least a month, until we catch up with this moving average, which then should support the whole move. Funnily enough, this projects to somewhere between 2300 and 2400 on the S&Ps, which is another 10% higher than we are at the moment. That is a pretty large move for what should be a market which can't really return much more than 4 to 5% real per year, and we shall address that a little bit later. So that is what we think at the moment is going on in the equities, and we shall tell you why later on. The same is not reflected in markets like the DAX and the rest of the Europeans. The DAX had a negative week, and really the most pronounced feature we have in these markets is the complete disconnect between the S&Ps and the other equity markets. The DAX had a negative week. It's still being compressed by the weekly Bollinger Bands in this 10,300 to 10,500 top to the 9,200, 300 area as a bottom. We think that that is likely to persist for quite some time. The same thing is happening in the stocks, which is even weaker, and basically the stocks are trading between a 3,100 area and a 2,700, 2,750 area on the downside. We feel that this is slowly going to back and fill towards the 3,000 area, just like the DAX is likely to make a higher move over the course of the next 2 or 3 weeks. And the Nikkei is actually even weaker, but much the same kind of pattern. It is doing all it can to stay above these February lows around the 14,800 area, and it has amazingly good support at 14,600. So really we think that we might get the same thing here in Nikkei. These attempts down are failing. We might get a big squeeze back up to around the 17,000 to 17,500 area, but not much higher than that. Gold and silver are also very interesting. Gold settled just below the trend line, but we're beginning to feel that, I mean, this price action is very similar to bonds, isn't it? 1, 2, 3, 4, 5, 6 weeks of up moves. So gold and bonds seem to be trading in tandem. So even there, would not surprise to see a little bit of backing and filling between 1300 and 1350 for the next 3 or 4 weeks before we attempt to break this area. Silver had an opportunity to put in a bearish hammer on the close of the week. It didn't. It is still outside, significantly outside the Bollinger Bands, and therefore it is vulnerable at some stage to crash back through them and go to at least this kind of area, 1880, 1850. But at the moment we are definitely not there. So we would not surprise to see wedge type action in the next few weeks, still contained by this weekly bar here. The currencies are the least interesting in technical terms, which surprises us somewhat. The dollar index is very well defined between the top around 96.50 to 96.70 and the bottom, which is around the 95 to 95 and a quarter area. We've already been 3 weeks inside that range and nothing much is managing to shake us out of it. The Bollinger Bands are compressing, which shows that after the compression, the move that happens probably should not be faded. We still anticipate that that move will be higher, but the technicals are telling us not yet. The same is reflected in all the currencies. Here we have a euro. It's basically still managing to go sideways in this 114 to 109 and a quarter area. The what is notable is that we are beginning to see a change in the MACD. So we are longer term bearish, but we would not be surprised to see squeezes into the 113s, 111s, 112s. So we are sellers of rallies only. We don't think that this is going to start cascading over the next few weeks. It is in nobody's interest that it should do so, and I think the Fed will and the ECB will ensure that that doesn't happen anytime soon. The yen is again telling us not yet. It keeps on coming back down to the 100 area, and we are longer term bulls of dollar yen, but we see no signs of rejection. We see absolutely no signs of a tradable bottom as yet. We are itching to buy dollar yen, but we just are getting no technical signal whatsoever that we should be doing so at this time. The Antipodean currencies actually are annoying the hell out of us. That's not look at the futures because those aren't as good. New Zealand dollar. Nothing much bearish about that chart, is there? It is being, and this is a weekly, it is being very well contained, the range that is, by this moving average, which is sloping up and accelerating. It is now outside of the Bollinger Bands, but it's closed right on its high. The RSIs are not yet overbought, so we feel in the next 2 or 3 weeks 75 to 77 is certainly doable. We are actually bearish of it, but we won't fight the trend. We see absolutely zero reason to sell the New Zealand dollar, and the same actually applies for the Australian dollar, which is much weaker than the New Zealand dollar, but has much more room to if it just rallied here to 77, 78, it would still be in a neutral area. And all these dips are being very well contained on a closing basis by this moving average. So although the New Zealand dollar is outright bullish and the Australian dollar is, well, should we say neutral, we feel there is a very strong possibility that it catches up to the New Zealand dollar and spikes the 78 Bollinger Band in the next 2 or 3 weeks. So we've given up on our bearishness in Australian dollars. It obviously makes no sense, although the macro reasons behind it are, we feel, sound, but the technicals are just telling us not yet, so we're holding fire. Since we feel that we are coming to very important levels in the equity markets, and we have been at very important levels in the bond markets for a while, I think it would pay to have a look at leadership in the various sectors. This is weekly charts XLF. We feel and have felt for a long time that the stock market can't really rally without the support of XLF as a sector. Well, it is beginning to get it. Let's have a look at a zoom in picture of the XLF. It closed above its central Bollinger Band and above this very significant MA, and we feel that the 2286, 2324 area is going to be key. What it does here next week, and if it manages to vault over 2324, 23.24, is going to be very significant for the stock market in the long term. We say this because next week we start getting the earnings releases, and the first ones are the banks as usual. So XLF will be very much in focus next week. Its price action is going to be key for the rest of the stock market, and we will be watching it like a hawk and telling you what our thoughts are. We are beginning to think that it might make a significant move higher, because there are so many ways, although it's illogical, to make earnings magically appear on the balance sheet of the banks, and we feel that that is probably what is going to happen. There's going to be some accounting magic which pushes the banks higher. Now, XLI, the industrial sector, has very little potential. You will see that throughout it is very, very seldom that you get a sustained move through the Bollinger Bands, through the weekly Bollinger Bands. These are weekly charts. The weekly Bollinger Band comes in very, very close to to where we closed, less than 1% away. The same is true of nearly all the other markets. XLV, which is the one that we are most bullish of long term is actually now through the Bollinger Bands. So next week should be a backing and filling and maybe closing roughly unchanged kind of week for XLV. Whenever it spikes the top of the Bollinger Band, it invariably comes back, even in very bullish periods like this. It spends at least 2 weeks backing and filling. So we would not be surprised to see much the same type of price action in XLV. Energy is actually doing nothing much. As you can see, these are weekly charts. It's put in a very good performance relative to oil. Oil got slammed last week, and here it is. Look how much oil got slammed. It got slammed nearly 10%. We feel that this is going to bottom somewhere around the between 44 and 42. And XLV has actually managed to stay pretty much unchanged, which is a decent performance. But there again, we don't expect any kind of leadership from energies. XLP, consumer staples, I mean, that just through the top of the Bollinger Band. It's the most defensive sector, and people are putting money to work at incredibly silly valuations and exceedingly stupid technical levels. So we don't expect much from that. If anything, we expect some give up at some stage. XLY, consumer discretionary. Again, weekly chart, very close to the top of its Bollinger Band. We would not expect a move, certainly beyond 81, or certainly not a close beyond 81, 81 and a quarter. So does it have move up? Yes, but it's barely a percent. The utilities, well, the utilities did nothing last week, but they're still through the top of the Bollinger Band. So again, we don't expect much from them, although this is invariably a longer term bullish chart. But don't forget, these are weeklies. We have lots of room to come back down and retest these areas around the 50 and 3/4 to 50 and a half area. So we have lots of room to come back down, just like we have lots of room to come back down in TLT. And finally, technology, where the Bollinger Band comes in at 45 at the top. We're now at 44. So again, not a huge amount of room on the upside, and that is actually reflected in NQ, where the Bollinger Band comes in at 45.80 and we closed at 45.17, so that gives us what, 2%. So we could get a little bit of leadership out of tech, but again, it's going to be muted for the next week, which all goes to say that we have a situation that we are overbought at these levels, that we might make marginal new highs from 21.30 in the cash. We might go to say 21.40, 21.50, but that at some stage we will have dips back. This 2075 to 2080 area now becomes extremely important. We feel that any dips back should be very well contained by this area. So we anticipate marginally higher prices next week. We anticipate people getting stopped out of their positions at these all-time highs around 21.36. We anticipate some stop-ins, some people putting money to work at silly levels, and then give ups of 1 to 2% at least before we try the upside again. The all the technicals are vastly overbought on the shorter time frames, so that would not surprise in the slightest. VXX at oversold, I'll do some, but again we feel that all rallies are going to be very well contained by these moving averages, which are now firmly pointing down, so we will be sellers of smallish rallies that we will get on the back of possibly marginal new highs in equities. Having gone through all the sectors, now let us have a look at what is going on and why. Well, we have prepared some snippets of information which we think give us a very good idea of what is going on and why. We shall leave this here for you to read, and these are the most salient sections. Call it the Kubler-Ross rally. After going through the Swiss psychiatry stages of denial, anger, bargaining and depression, portfolio managers may have reached the final one, acceptance, in dealing with the descent of interest rates to lows once thought impossible. And this is the other one. Cash is piling up in portfolios as a result of the flood of bond calls, maturities and interest coupon payments, observes Mark J. Grant, blah blah. That demand outstrips supply and explains the headlong surge into bonds and the plunge in yields, which he has steadfastly predicted, including some 14.4 billion going into fixed income mutual funds in the latest week, dwarfing the 470 million inflow into equity funds. Please read the whole section. It is very informative. We certainly have seen a flood of cash hit our portfolios from coupon payments, from dividend payments, and the cash levels that we are holding are extremely high, and we had to start whittling down that cash position and putting some money to work. Now, if you look at this chart, which is the total return for the past 20 years of the bonding index funds and the SPY, you will see that the bonds are actually outperforming stocks with much lower volatility. That is one of the basic reasons that people are putting money to work into bond funds as opposed to equity funds. So it's not so much a risk on, risk off trade as a get me any kind of yield trade. We feel that these will now move more or less, of course, not absolutely in sync for the next, I would say, 6 to 12 months at least. This is another very interesting chart. It shows the dividend yield. Let's see if we can actually, of the S&P and the 30-year bond. They are now on top of each other. There is nothing much to choose between the dividend yield of a bond and the dividend yield of the S&Ps. Well, those are extreme positions. That presupposes that you can see no growth out there, because if you could see any growth at all, you would prefer to own equities over bonds. The next few slides we've taken from Travaco Capital, who've done yet another excellent video this week, and we would recommend that you go and watch it. And he's quoting Bill Gross, showing that in the 90s and early part of the 2000s you had very rapid US credit growth, and now you're having very tepid credit growth. Without credit growth, it is very difficult to see growth in the economy and GDP, and therefore it is very difficult to see much appreciation, sustainable appreciation of equity prices, because if GDP can only increase by 2% a year, say, and there is only so much efficiency saving that you could put into share prices, and therefore it would be more than reasonable to expect that the yearly average return on stocks cannot be much higher than 4 to 5% per year. Well, considering that we closed last year at 2030 in the S&Ps, and that we are already at 2130, we've already had the 5% growth, and we are only 6 months into the year. Therefore, it would be reasonable to expect that the second half of the year would see a return of more or less zero. Well, maybe a sustainable return of zero, but that doesn't mean that the market can go up 10% and straight back down 10%. And that is the danger that we face. We see a lot of cash sitting on the sidelines, and a lot of people knowing that the valuations are extreme, knowing that they don't really want to put money to work at these valuations, but being forced to do it by both bond yields and sheer weight of money. That actually explains these amazing numbers from Friday's trading. Up volume 94%, down volume 6%, unchanged volume 0. Total volume well above average, so advancing issues 87%. Overall, we are seeing incredibly good breadth from the move on Friday. And here we come to the but. But the NYSE Composite has still not managed to take out its triple top. It needs over the next few weeks to vault over the 10,650 area. We shall see if it manages it. We are pretty positive that it will, but whether it will sustain it is another matter. We are getting to a schizophrenic stage in the markets. People know that these are the wrong valuations to invest in for the long term, but on the other hand, TINA is very strong, and fear of missing out is very strong as well, which will produce some very volatile trading, because there is nothing worse than knowing that you bought something at a bad valuation level that makes you nervous and makes you want to dump it as soon as it starts going down. And guess what? That's probably going to be somebody else's entry point, and you were going to be squeezed, and then when it goes back up you'll say, oh no, I'm going to miss out again, what have I done? And then you're going to rush in and buy at the highs again. So it's going to make for very schizophrenic markets over the next few weeks, we feel. And here is another but. This is the NYSE Composite weekly against defensive bonds. TLT. Still in a downtrend, and in a week as strong for equities as last week was and the week before, TLT is still outperforming equities. Now that is amazing. We are at record low yields and still equities cannot manage to outperform TLT. In pure risk on risk off terms, the rally in February was much healthier than this latest rally since the, let's call it the Brexit low. Although we feel that we will make new highs, look at what the S&P has done relative to TLT. It's come off. A lot of people will start asking themselves, well, how is that possible? It's possible because TLT is actually pushing up the valuations and the multiples in the S&P 500. It's not a sign of strength in the S&Ps. It's a sign of extreme weakness in yields and strength in TLT. And looking at this chart, it actually makes sense. This is money velocity. Without money velocity, what growth can you possibly have? Look at the slope of all these lines. They're all making new lows constantly. If that is the picture out there, it is very difficult to see what growth equities can possibly give you which is sustainable. All they can give you is multiple expansion, and multiple expansion, as we know, is the most dangerous form of appreciation there is. So now let us go and revisit our favorite indicator, the Blue Angels. As you can see, we bounce ferociously off the times 16 multiple because of the fall in bond yields. Can we now go to the times 17 multiple, which is just over 2150? Of course we can. But these lines are moving up so slowly. The slope of them is so shallow that all we are doing here is actually going from one shallow line to another shallow line. Can we go to times 18? Well, yes we can. Can we go to times 19 towards 2400? Of course we can. And that is what the technicals are actually saying that we will do. But also that shows that the multiple expansion will at some stage be given back, and be given back ferociously. Let's have a look at the individual sectors that we've already looked at. Well, consumer discretionary, can it make new highs? Absolutely. But look at the slope of these lines. There's just no growth. There's nothing there. And don't forget, these are expected earnings, okay? Actual earnings are always lower than expected earnings. Consumer staples. Well, we've never had valuations like these, and I guess we will keep on going higher and having even more ridiculous multiples, because people don't know what to do. They want to be invested, and on the other hand they see no growth, and therefore they're putting money to work at silly valuations. But then again, the yields that you can get for a comparable 30-year bond is also silly. So everything is getting sillier and sillier, which is, to tell you the truth, in our experience, a very common feature of fifth waves in the stock markets. Fifth waves make no sense at all. Everything is expensive, and yet everything keeps on going down. And when it starts going down, people bail out, but it's not the bottom yet, and they get squeezed back up, and they buy the high again. until it really is the high, and then it all collapses. Energy, no leadership, no chance. This is gonna take years to normalize. Years. Don't buy it. Financials, we will probably get some levitation, as we said, next week because of earnings results, and that might push the general index up a few points, but that's basically it. We just cannot see, in a world where earnings on asset management, where credit growth is as weak as it is, where people have as much cash as they have, that anybody needs the financial sector. Who needs to invest, and who needs the backup of the financial sector? Are you seeing huge M&A activity? No, you're not. You're seeing one of the lowest M&A activities ever, and therefore fees are low. But we are quite sure that the likes of Goldman Sachs and JP Morgan will manage to spring a surprise, and somehow through fantastic financial accounting and engineering come up with results which are at least in line with what the street is at the moment expecting, and therefore we shall see a 4, 5, 6% rally in their stock price. That's what they do, so don't be surprised if you see it. Healthcare, our favorite. Again, growth is tepid, but still one of the least expensive defensive sectors, and that's why we like it, although we think that next 2 or 3 weeks are going to be fairly boring. Industrials, well, yes, maybe you can see a little bit, maybe a higher high by 1% or 2, but look again at the slope of this line. It has gone nowhere for 2 whole years, and we cannot see it going anywhere. So this is, if it goes up, it's just multiple expansion again. Information technology probably has more room to rise, which is just what the technicals are showing you in XLK. So and the Nasdaq. So we would be rather buyers of Nasdaq and XLK than S&Ps and or the Dow. Materials, well, yes, can we go up to the times 18 line like we did here? Yes, absolutely we can. But even that is a 7-8% move, and then after that we should basically stall. So everything that we are seeing is indicating that, and here comes the telecoms, very close to that 15 line. Can we go higher? Yes, we can. But everything is indicating, and look at utilities straight through the times 18. So we're basically just getting multiple expansion and no higher earnings whatsoever, and that purely indicative of what's happening to yields, comparable yields. So that is the situation that we're in. Again, we have extremely low dividend yields, but then again we have extremely low 10-year yields. 135 on the 10-year. Would not be surprised by a trade from the 130 level, maybe with bounces into the high 140s, but eventually we see this coming back to below 1. And the one which is even more amazing, the Bund. Look at the huge gap we have here from 10 basis points all the way to -5, and now we're trading a whisker away from -20. negative 20 basis points and people are still buying it. Well, they're certainly not buying it for the yield. They're buying it because they are absolutely scared of the alternative, and the alternative is DAX and stocks and risk. Why are they so scared in Europe? That is a very interesting question, which we will give you an idea about. We would recommend that you read this article by Ed Giardini about bond yields. We think he's spot on right. And let's have a look at what the calendar has in store for next week. And although you'd get some quite interesting numbers, the big thing is going to be on Thursday, which is when the Bank of England comes up with its interest rate decision. We think that everybody has bought everything from bonds to equities ahead of an expected easing and or additional QE from the Bank of England. It might very well be a scenario where we rally Monday, Tuesday, Wednesday, and then we come off on Thursday on either a disappointment, which is fairly unlikely, or a buy the rumor, sell the fact type trade. That is more likely, but in any case we would have thought that any gains in bonds and or equities that we've made Monday, Tuesday and Wednesday, we could quite easily give up on Thursday. Now, what does all this that we've been telling you throughout the past hour actually mean for trading strategies? It means being patient and not chasing prices higher, but waiting for them to retrace to the longer term moving averages, which we shall tweet throughout next week, and buying them off those. Those are good entry points, not what the market will squeeze in the first couple of days of trading week. It means being quick to take profit on any longs, say above the 2140 level in ES, and maybe establishing shorts via puts that one would want to hedge very quickly if you get a 20 to 30 point move back down. But certainly any longs around the 2135 to 2140 level should be exited and used as any backup, used as a getting back in opportunity. 2175 to 2180 is going to be our line in the sand on the way down, where we really would like to own the market. Now, what does it mean in terms of our preferred assets? What do we do? How do we invest our own money? Well, it seems to us that if you have a situation where bond yields are going to stay permanently low and possibly going lower, certainly where you want to buy any backup in yields, and you have a situation where the stock market is probably going to have a multiple expansion at some stage because people just don't know what to do with their money, the best and least volatile place that you can put your money in is HYG. HYG, this is a weekly chart, has done very little for coming on to 3 months, and finally on Friday it broke out. We bought that breakout on Friday, You can see that it's gone to the top of the Bollinger Bands, and you can see downward sloping moving averages, but we still feel that it'll go and trade in this, between these areas of 90.25 and 86.5, which have caught tops and bottoms before. That is still a 5-6% move, which is a reasonable move to expect from HYG, which has been so very well behaved, and you can see how it's being caught by these moving averages all the way from the February lows. We would expect this to be the most stable and therefore the least risky investment over the course of the next 3 to 6 months. We'd expect it to trade certainly not much lower than 84 in the next 2 or 3 weeks, and potentially all the way up to 90. Well, that gives you almost a 10% return over the next 3 to 6 months. That's why we like HYG. It's yielding close to 7%, and therefore we feel that it has a very good reserve should we get some bad news at some stage for equities and or bonds. So that is what we're doing with our own money, rather than putting it to work at ridiculous valuations naked. We would rather buy HYG. We feel that the upside is nearly identical to the upside in equities, or very comparable, and the downside is much less exposed than it is in outright equities. The other thing that we're doing is we're buying individual names, again selling calls, i.e. nothing, not a very exciting strategy, especially with volatility as low as it is, but we feel that even that is better than being outright long. And we have bought some put protection at much lower levels, which cost us next to nothing, just in case the wheels fall off the market. Because make no mistake about it, we are in a very unstable position. We are nowhere near an equilibrium in these markets. Wave 5s are very unpredictable waves, if we are correct, and we are in a 5th wave. They can be truncated, they can be elongated, but more often than not they resemble, as we said, wave 1. So we would expect this slow grind up as we had in 2009, beginning of 2010. But make no mistake about it, wave 5s do end, and the retrace from wave 5 should be at least 0.382 of the whole move. So let's work out what that move is likely to be. Well, if we assume that now we grind up to 2,400 and then retrace the whole of this move from the 666 lows, you are getting a target at only 0.382% retracement around the 1750 area. So basically taking out these lows at some stage next year. That is why we're saying that this market is extremely unstable. We might go up even a whole 10% now, but still we expect at some stage next year to be able to buy it below these lows. Bold calls, but again, that is what we are seeing. That is what is making sense from a macro standpoint. We all know that growth is low, that velocity of money is low, that the credit expansion is low, and this is just people chasing yields. This is very beginning to be very reminiscent of 99 and 2000, and we all know what came after that. It won't be hopefully as bad as the Nasdaq crash, but it'll resemble it at some stage, we're quite sure. Thank you very much.